Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Every product has a story, that of its identity, origin and creation. Making the India story come to life is the large manufacturing industry that covers a spectrum of creations. They keep the wheels of the nation moving. The manufacturing segment has the potential to be a major driving force in the Indian economy. There has been a great manufacturing push from the government. Initiatives like Production-Linked Incentive, Make in India, National Manufacturing Policy, Skill India, Samarth Udyog, Industry 4.0 are a few of the examples towards potential of this sector. The Nifty India Manufacturing Index aims to track the performance of stocks that represent manufacturing sectors in India. Nifty India Manufacturing Index has performed relatively similarly without IT and financial services and has outperformed Nifty 500 Index during the period of economy recovery and Make in India push. Riding on this potential, we present to you Mirae Asset Nifty India Manufacturing ETF Fund of Fund, an open-ended fund of fund scheme predominantly investing in Mirae Asset Nifty India Manufacturing ETF. The fund aims to provide broad exposure to the key manufacturing segments of the Indian economy. It may potentially allow investors to participate in the growth of key manufacturing segments which are the focus areas of the government. Offers potential benefit from emerging spaces like electric vehicles, defense and electronics. Provides a relatively low-cost and rule-based investment approach to take exposure in the manufacturing theme. If you are an investor who has an aim of wealth creation and a very high risk appetite, then you may consider Mirae Asset Nifty India Manufacturing ETF Fund of Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Every product has a story, that of its identity, origin and creation. Making the India story come to life is the large manufacturing industry that covers a spectrum of creations. They keep the wheels of the nation moving. The manufacturing segment has the potential to be a major driving force in the Indian economy. There has been a great manufacturing push from the government. Initiatives like Production-Linked Incentive, Make in India, National Manufacturing Policy, Skill India, Samarth Udyog, Industry 4.0 are a few of the examples towards potential of this sector. The Nifty India Manufacturing Index aims to track the performance of stocks that represent manufacturing sectors in India. Nifty India Manufacturing Index has performed relatively similarly without IT and financial services and has outperformed Nifty 500 Index during the period of economy recovery and Make in India push. Riding on this potential, we present to you Mirae Asset Nifty India Manufacturing ETF, an open-ended scheme replicating Nifty India Manufacturing Total Return Index. The fund aims to provide broad exposure to the key manufacturing segments of the Indian economy. It may potentially allow investors to participate in the growth of key manufacturing segments which are the focus areas of the government. Offers potential benefit from emerging spaces like electric vehicles, defense and electronics. Provides a relatively low-cost and rule-based investment approach to take exposure in the manufacturing theme. If you are an investor who has an aim of wealth creation and a very high risk appetite, then you may consider Mirae Asset Nifty India Manufacturing ETF.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Every product has a story, that of its identity, origin and creation. Making the India story come to life is the large manufacturing industry that covers a spectrum of creations. They keep the wheels of the nation moving. The manufacturing segment has the potential to be a major driving force in the Indian economy. There has been a great manufacturing push from the government. Initiatives like Production-Linked Incentive, Make in India, National Manufacturing Policy, Skill India, Samarth Udyog, Industry 4.0 are a few of the examples towards potential of this sector. The Nifty India Manufacturing Index aims to track the performance of stocks that represent manufacturing sectors in India. Nifty India Manufacturing Index has performed relatively similarly without IT and financial services and has outperformed Nifty 500 Index during the period of economy recovery and Make in India push. Riding on this potential, we present to you Mirae Asset Nifty India Manufacturing ETF Fund of Fund, an open-ended fund of fund scheme predominantly investing in Mirae Asset Nifty India Manufacturing ETF. The fund aims to provide broad exposure to the key manufacturing segments of the Indian economy. It may potentially allow investors to participate in the growth of key manufacturing segments, which are the focus areas of the government. Offers potential benefit from emerging spaces like electric vehicles, defense, and electronics. Provides a relatively low-cost and rule-based investment approach to take exposure in the manufacturing theme. If you are an investor who has an aim of wealth creation and a very high risk appetite, then you may consider Mirae Asset Nifty India Manufacturing ETF Fund of Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Every product has a story, that of its identity, origin, and creation. Making the India story come to life is the large manufacturing industry that covers a spectrum.
Good evening and welcome to the 4th edition of Innowave by Mirae Asset ETF. This is an event which is dedicated to passive investing and the magic that exchange-traded funds can really spin into your portfolio and then into your investment journey. When we started Innowave back in 2020, we saw the big potential that exchange-traded funds present. We saw how even in a country like India, a country that loves active stock picking, ETFs had started to pick up in a very, very meaningful way. Now, in all of the years since then, it's been 4 years, the market has staged a mega rally, and one that until just a couple of months ago was pretty much completely uninterrupted. It is in this setup that the beauty of passive products have really been on full display. Now, the growth in ETF investing isn't really surprising at all. We have seen this model play out in several different economies in the developed markets specifically, so markets like the US, and it makes us very confident of what is to come for ETFs in our own market as well. You look at the growth in passive schemes along with the overall growth that is expected in the capital markets in India, that is expected in our overall economy, and the future appears even more exciting. We have, as a fund house, decided to focus all of our research capabilities on laying out all of these innovative products, these unique products, and bringing them to the market. We've gone back multiple years, back-tested models, our stock selection mechanisms. So we've gone back 20 years to really put our ideas to the test. And it is in that context that I want to lay out the theme for Innowave 2024, which is capturing the rise of New India through exchange-traded funds. Now, through the course of this event, we will speak about several different themes that really stand out to us here at Mirae Asset, the pockets that look well positioned, the rise of smart beta, as well as the new Indian economy, which has of course been created by a whole new set of consumer preferences. But first, to just set up the context, to talk about the key ETF trends as we see them today and the broad Mirae Asset strategy, let me invite on Swaroop Anand Mohanty. He's Vice Chairman and CEO of Mirae Asset Investment Managers.
Hello everyone, and it's my absolute honor to welcome you to the 4th edition of Innowave. I remember in 2020 when we started this, there was a lot of discussions internally as to should we do it, are we too early to discuss ETFs in the Indian landscape. But today, when we look at 5 years from that date, the entire industry, the landscape, from both an advice perspective as well as from the investor perspective, stands completely changed. And that's just the beginning, to put it in a very mild manner. I'm here to discuss what we think is how the landscape has played out. And let me sort of talk about it in the form of numbers. Just to start with, a very interesting landscape that is playing out in India, and probably the only one in the world, where today the number of demat folios are double of that of mutual fund folios. A lot of people ask us, why do you do ETFs? I jokingly say because that's a larger market than the mutual fund market. But it is a fact that when they crossed 10 lakh crore folios, mutual funds are trailing behind at 5 lakhs. Let's see how it unfolds in the next 5-10 years. But as it stands, the way the demat accounts have unfolded, and many people refer to it as a bull market phenomena, I firmly do not agree to that. I think with the demography of India unfolding, the broking industry and the growth of broking accounts and demat accounts are here to stay, and there will be a secular growth from here on. As a part of or referral to that industry, what happened going forward was just an outcome. And slowly but surely, what was just 2% of industry folio AUM just 4 or 5 years ago, today is almost 16% of industry folio at a retail level. When we look at the ETF market, it is seeing a surge of consistent inflow of ETF or new investors. You can say that it coincides with the demat accounts, but I have other views on this, and that's something which we'd like to refer to as we go on. As a result of a lot of focus from the government, and that's always the prerogative of the regulator and the government to see that a kind of industry grows. It started with an inflow of the EPFO into the ETF market. but now has resulted into non-EPFO, or we can say the individual money also beginning. When you look at the active industry, when I started the industry, joining the industry, say in the late 90s, 70-80% of our AUM was held by institutions and corporates. Today, when you look at that industry, 65% of the AUM is held by individual investors. And as we speak, we are seeing the surge of individual investors in the form of numbers. I dare say in the next 5-10 years, you will see the AUMs following. But both AUM and folios have seen consistent growth in the last 4 or 5 years. I mean, when you look at the landscape post-COVID, what we are seeing at the individual investing capacities, both in the form of number of products that people are imbibing, as well as the form of investing, is changing per day. Just to take this story forward and you look at why this is happening, one, of course, is the digitization and the ease of transaction, but I give a lot of credit to the number of products that are being launched. I mean, it's very interesting in this stage of the mutual fund industry in India. When you look at the active side of the industry, it has the categorization of funds. But the beauty of the passive side is there is no such restriction. And I feel due to the talent that we have in India, and of course, our ability to see the growth of the global passive industry, we can pick and choose and go straight forward to certain solutions which have done well in the rest of the world. A big example is the way our smart beta products are growing. And then today, when we look at the number of smart beta products, they are growing by the day, and they're, I think, 32 as we speak. But when you watch this space, the point I'm making is we didn't have to go through market cap, thematic to reach at smart beta. We went straight there. And today, when you look at it from an investor or an Indian investor point of view, I personally feel the next 5-10 years belong to smart beta, and the ability of India product managers to deliver sharper products on this part is something which we'll have to watch out. That's something which I'm playing out at the beginning of this presentation. And I feel in the next 10 years, it's a space which one has to watch out. But at the same time, when advising is perceived to be made simple, I mean, when you look at the growth of passives, it's because of the number of choices that people have been given and the ability to kind of choose from them and form a portfolio. A lot of growth of the ETF industry should be attributed to the number of products or the choice that the investor is slowly but surely getting. When you look at the other side of the story, when you start building an ETF business, mostly it is felt that it is the products which drive the business. But finally, it is the efficiency of the products in the capital markets which defines whether the growth of that industry will happen or not. And that we are seeing that in the last 8 years, we've seen ETF trading volumes going up by almost 10x as we speak. Even today, the growth of all sectors of this and the different categories of volumes consistently growing is what is making all of us believe that in the next decade, you will see the rebirth of investing in India in the form of ETFs and passives. And that's probably one of the best things to see, more investors coming in, trading on a regular basis, and more attraction to these products. And hence the overall environment or the business starts taking a certain shape. Just to give you some things in perspective, if you go back to the way liquid funds or the ETFs were traded, bulk of it, few years ago in 17-18 was liquid. Nearly 80% of the traded volumes were liquid. But today, we are seeing a far more broad-based way of approach from the investors. That 70-80% of liquid is now almost 44-45%. Though a bulk of it is still in the broad-based or the market cap indices, but we have recently seen a fair amount of growth in the thematics. But again, I bring you to a small maroon part of that slide which just shows the smart betas. When you look at the next 10 years, you will see this broad basing even more than what it looks today. And I think for me, the cake was eaten on the days when the investor sentiment or the behavior of the investor completely took a sea change. And today when the markets go down, we see the volumes of all the ETFs in the market just goes up. Just shows a dramatic change, or practically from my perspective, a huge U-turn in the way investors used to behave and the way investors are behaving today. On the day market falls, the volumes of all ETFs just go up at a very different level. We've given some examples, and you can see those dates And then the beauty of the whole thing is, as the falls continue, the volumes start growing steadily. And today, the Indian investor is looking for those days to accumulate money, and there cannot be a better way of investing as we speak. The more we collect money on those days, the bigger chance of wealth creation in the future. And hence, when you look at all these points closing in, it's great to see the data points falling into place, and the future looks just a kind of beginning to set. And I can say with a fair amount of confidence that the Indian ETF market is formed a brilliant platform to start growing in the next 5-10 years. From our perspective, I think ETF now forms a great backbone to our global mutual fund sales. And then we manage around 136 billion across 11 countries as we speak. We run 3 brands of ETFs. Under 3 brands, we run them. We run the Global X, which we acquired in the US and then rebranded our Canada business in the form of Global X. In India, we run it as Mirae Asset Global Investments. And in Seoul, we run it, or South Korea, we run it under the umbrella of Tiger. But within them, we run 688 schemes, which is growing by the day. And the AUM, as you can see in the slide, is consistent year on year. Last year, of course, was a brilliant year for us because some of the thematics in the US and Canada took a different kind of turn, and our AUM shot up. Plus, I think we've seen consistent growth of our AUM in India itself. But when you look at this map and you look at the next decade, I think a lot can change from the India size perspective. And that's something which we look forward to as we start building a strong base for ourselves. We are extremely differentiated when it comes to our ETF strategy in the market. We primarily focuses on building good, strong, and differentiated products. We bring a cost angle to it, and most of our products are fairly well, from a TR or a cost perspective, in the favor of investors. I think we definitely focus on the efficiency and giving you a good, well-tracked index to you, back to you as an investor. I think when you look at the future, we'll continue to market them through the broad market. What we bring to you is an exclusivity which very few players in the market bring. We stand with our own market maker in the form of our group company, Mirae Asset Capital Markets. And we also intend to diversify in the form of algos going forward. And our aim is to lower the spread, and the aim is to practically lower the spread and give you a good product at a good impact cost when it comes to your investment. More and more, as we develop this in business, our whole objective is to make it as client-centric as possible and give you a good product which is tracked well at a good market efficiency. That's the whole mark of building a good ETF business. That's what we aspire to do. I think the FOFs today, post the taxation, give all investors a great chance to own the same underlying ETF in case you don't have demats. And I think most of our ETFs come with a good FOF in the front end, especially the ideas which we've developed ourselves. We intend to continue this strategy of giving you good FOFs. So please, for some who do not have demats, can look at the same ETFs in the form of FOFs. I think from our end, we continue to develop a strong ETF team. I dare say, as somebody who represents them in the market, we've developed a very strong, efficient team from a product side to the dealing side. Please track our products and see the efficiency unfolding in front of you. And lastly, we will continue to improve the investor experience with our growth in the market. We stand very differentiated in the market with our product team and our market maker in front of you. And we look forward to your continued support and looking forward to building an extremely strong ETF franchise in front of you in days to come. But on behalf of Mirae Asset, I'd really thank you today. We have an exciting line of speakers today and look forward to hosting you again in the years to come. Thank you so much for being such a wonderful support to us.
All right, thank you so much for that, Swaroop, for really taking us through Mirae Asset's overall strategy on ETFs and the trends like we see them today. You know, Mirae Asset globally is very, very big on exchange-traded funds. This is something that Swaroop was alluding to as well earlier. And it is to really expand this division that the group went ahead and acquired New York-based ETF provider Global X also. This was back in 2018. So the focus is and has been on this segment for a while now. But since we're talking about a new India, a change that I'm sure we've all witnessed in some form or another, specifically since the onset of the COVID-19 pandemic, is that a large number of people are really making their way to the Lal Street. But you know, I was looking at a very interesting stat which shows you that yes, the trading, the investing population in India has seen a big spike. But you know, when you compare it to other metrics, say the number of people that have access to a smartphone, that use social media, for instance, it is still just a small fraction. So this is still a hugely underpenetrated market in India. If you look at demat penetration, it still stands at just around 12% in India. Let me give you some context. If you look at the US, this number is over 60%, 62% to be precise. So what it means is that yes, the growth has been absolutely remarkable, but we still have high potential for high growth in this space. With that said, I would now like to hand it over to Umesh Kumar Daila. He's head of ETF sales at Mirae Asset Investment Managers, and he is going to have a very interesting conversation with Jay Prakash Gupta, who's co-founder at Dhan, which now is one of the top 10 largest broking apps in the country.
Thank you, Pavitra, for the introduction. Today we have a very special guest who has seen the journey of FinTech from, I think, from Karvi days to here. He has a very strong credentials, so I have to take paper to, count those. So he was heading Karvi e-broking from since 2006 till 2009. Then he was heading commodity and currency at Mangal Keshav Securities between 2009 till 11, and then he became founder and CEO of Moneylicious, which was established in July 2012, and then now as we speak he is a promoter of Dhan and also a co-promoter of Raise Financial Services. So welcome Jay for on this fireside chat. The objective of today's discussion is to just think about or to understand more about or maybe I must say to reimagine the Indian investors and the influence of FinTech in it, because I'm sure we have seen that when it comes to stockbroking per se, the time has changed. I think from long back when I started my career, I used to see that opening a demat account used to be a challenge, and there were very few people who used to have, and then whoever used to have used to be in that office of that stockbroking firm, and full day they used to spend there while doing tradings and everything. And I think things have changed, and it has changed, I must say, dramatically. But I would like to understand from you what is happening, because you are being part of that side of the table. You can give us more clarity that how things are shaping up, how things are. So just to start, I just want to understand if you can talk about how broking industry has evolved in last 10-15 years, how it was earlier, and what are the changes which you are seeing right now.
Yeah. First of all, thank you so much, Umesh, for having me at your fireside chat. It's a pleasure to be part of Innowave 2024. And the way you have explained about my experience, I'm feeling a bit elated and a bit old, the kind of words which you mentioned. Thanks for that. I'd like to take you back when I was assigned a responsibility of setting up e-broking business at Karvi. Okay, the project was e-broking, but the way the technology at that point of time in India was and what it is today, there is a huge difference in it. And and coming to your question on what has changed in last 10-15 years, see, broking industry in India has evolved. I would say that. And say I just don't want to go 20 years back, but say a decade back. Okay, broking in India was more to do with leverage and pricing. What I mean by that is, see, any broker who would want to retain a customer or want to acquire a customer, the only the selling proposition at that point of time, I'm talking about retail broking per se, was what kind of leverage you allow to a customer. Okay, and how would you cut your brokerage or pricing vis-a-vis the the client is getting from his existing broker. So those two are the primary incentives for a user to move from one broker to another, and for a broker to get a new client. Okay, the innovation about product and everything was always hovering around how you design, leverage, and pricing, and how you bundle them and offer to a customer. Okay, the concept of having innovations in your product, bringing new features, creating that wow moment for a customer, those were not a great determining factor, at that point of time. What started changing was obviously in 2016. Okay, I would say that 2016 or 15-16, created the foundation from where the innovation, the use of technology and adoption of technology by retail users started emerging. It all started with government's initiative of going the digitized way. Okay, they introduced Aadhaar-based KYC. Prior to that, opening an account, as you rightly mentioned, was a tedious job. Signing 40 odd pages of a booklet, which was 50 pages, thick. And apart from that, the reach was not there, because for somebody who is in Assam and he wants to open an account with a broker in Bombay, sending a form and getting the form back and verifying whether everything was correct or not, that used to take 1 week. Okay, the things were bound to get slow. And with digitization, with Aadhaar-based KYC, things started changing. And that was one of the, triggers which created, a lot of interest. Users found it very easy to open their accounts, and they started coming there. The second big trigger which happened, which I feel, was when regulators decided to end the leverage from the market, right? So prior to that, any XYZ broker would just tell his clients, hey, you have a lakh of rupees, I'll give you 10 times or 20 times leverage so that you trade more. Because when you trade more, what I'll earn is a brokerage which will be higher, because the brokerage at that point of time used to be a percentage of your turnover. Okay, so that was a motivation for a broker to give higher leverage. But when the regulator made it mandatory that the leverage cannot be more than the capital which a client has, and that kind of created a level playing field for everyone. Now there was room for creating those customer experiences, bringing new features on the app, and the whole game of shifting from price and leverage to more about product and customer centricity, that started taking off.
So I must say what you said is right. A lot of changes have happened. It became level playing field. So what all events which happened, maybe if you can name few, which has disrupted this broking industry for last maybe few years, which is where we can see right now in industries. If you can name few, will be helpful.
See, I would say the primary disruption which started happening was when government took the initiative, which is a JAM trinity, right? Where Jan Dhan account was introduced. You had, Aadhaar-based KYC, and mobile was used for doing that. As people got into the bank, I would say that the unbanked, when they started finding an opportunity to open a bank account, okay, that made a difference from whole financial services perspective. From broking, the ease of opening your accounts through your mobile by doing Aadhaar-based eKYC, that was one of the moments, which created disruption. Second was when SEBI ended those leverage, and third, I would say, when earlier for any broker, the exchanges were providing a platform which was free of cost. It was just a plug and play thing for them. And that helped a lot of brokers to reduce their technology cost drastically. And since it was a product which was provided to everyone, nobody thought of innovating their own products. Okay. But when exchanges ended that kind of platform, okay, they were not providing it further. Okay, then the onus was on the broker that if I'm able to allow clients to trade on my platform at the fastest possible time, what should I do, to create a mobile app? And that's how, the whole thing started, I'd say.
So I think it's right to say that digitization is something which is the key change, which has changed, and I think it is at a forefront, if I'm not wrong, in broking, if I talk about. If yes or no, maybe if you can just put some light on that how important for you as a broking, from a broking side, how digital or digitization is important for you, and maybe how you can reach out the wider audience through that. If you can just put some words on that also, will be helpful.
No, today, see, digitization is inevitable. You cannot survive without technology and without digitization. And I can, take you back in how the MIIs work. See, right from exchange to clearing corporations to depositories, everybody is working on kind of bringing everything on a real-time basis. From now, we have moved from a T+2 settlements, we are moving to a T+0 settlement. This will not be possible if the everything on the back end, on everything behind, which the MIIs created, that kind of infrastructure doesn't use or adopt technology. Okay, so technology is definitely at the forefront. Now, for intermediaries like us, technology plays a greater role because the user behavior has started changing. I'll just like to bring some data here, some number. Say, if you see the total number of demat accounts, the kind of phenomenal growth which we have seen. We'll come to the reasons for that later. But in March of 2020, the total number of demat accounts in India was 4 crore odd number. In October of 2024, that number is close to 18 crores. We have seen 4.5 times jump in a span of 4 years. What it took 30 years to reach 4 crore demat accounts, and from there, so we can, yeah. So second is, if you see the median age of a demat account holder in India has come down from 38 which was in 2018 to 32 in 2024. And the total number of demat accounts which we have now, which is around 18 crores, out of that 40% demat accounts are with the people who are less than 30 years of age. Okay, so it shows that and one more data, by the way, that every year we see that 12 million new people are joining the workforce every year, yeah, which is around 1.2 crores. Okay, so when it's combination of organized and unorganized, and for a person who has just joined the workforce, his salary is limited, and for him the first preferred choice of investment is having a demat account or investing through demat, because with his kind of earnings and salary bracket, they cannot buy real estate or they cannot buy any other asset class. Okay, so with this data, okay, if we see that the first time user, and apart from that, another advantage which is there is that these new workforce are tech savvy. Okay, they know how to use applications. They use technology to the fullest. They have access to information, and all this is translating to intermediaries like us to create that kind of seamlessness on our applications, on our trading platform, so that the user who adopts the technology well should be getting that wow experience on being on the platform.
So basically, it's experience also that matters. Now, as you touched upon that, there are the median age has come down. Now, if you can just throw some more light, that what is the customer base mix we have right now, maybe in the industry or at your end, if you can mention what is the age bracket you already highlight. Maybe if you can put some light on income bracket, what sort of risk appetite they have. I mean, the overall customer mix, I'm definitely sure would have changed, because traditionally investors' behavior changes, the choices of investment changes. So accordingly, I believe this mix would also must have seen some significant change. So how it is there right now in yours, maybe your side or in broking industry per se, if you have some data?
No, I'll give you data from an industry perspective, which I told that right now 40% of the demat accounts are of people who are less than 30 years of age. Okay, and as a country, our median age of the country is around 28 years. Okay, so we are a pretty young country. When you have a median age of 28, these people are risk takers. Okay, irrespective of what income bracket they are into, and with the advent of technology, with access to information, this generation, or millennials and Gen Zs, I would say, to put it that way, are aspirational. Okay, they want best of the products at the shortest possible span of time. Okay, and that applies to their investing behavior and trading behavior as well. They want something which is quick. Okay, they want something which gives them a lot of excitement. Okay, so this age group want to invest. Their way of investing and their way of approaching investments and savings and creating wealth is very different from the generation which is a decade old. Okay, so they want everything quick because of the social so I would say the social environment around, because they are hooked to social media, where every post they put in, there is an expectation that it would be liked by someone. So that instant gratification thing is very high. Okay, so that also translates in their investing and trading behavior. So they want something which is quick, which is seamless, which values them. I'd just like to bring one data here. See, in India, especially, I'm not talking from financial services, but in general, if you see the kind of benchmark which Amazon has set in terms of customer centricity, that they truly treat any individual or any customer as a king. How it works, we all know, right? If you want to return your product, if you want to claim a refund, there is no question asked. Okay, and once you have that kind of experience, any typical user, wherever he wants to shop, he wants to buy a product, he wants to order a food, or he wants to invest, has expectation of meeting that benchmark. Okay, so as an intermediary of financial services or a broking entity, we also have to keep that in mind, that am I able to meet the expectation of my user, because there is someone who has set that expectation very high. So today for a user, it's not about pricing, it's not about leverage, it's about how well you take care of your customer. The customer centricity has become the prime focus, and that is followed by your product and your technology.
So the old saying, the customer is king, is actually playing out here.
Exactly.
It's playing out here. Who is doing well is also getting rewarded from the market. So as you touched upon that investors are looking for investments and they are investing. So I firmly believe, this is my belief, and I think I've heard it also, that the time changing, the traditional way of investing are changing. Yeah. The products which used to be liked by traditional investors, the old investors, might not be liked by new age investors. So whatever products were popular for 5 years back, they might not be popular now, or maybe 5 years from here. So are you also seeing that similar kind of behavior in clients also? And second question is, are they investing? When I say investing, I believe it's a long-term investing. This is what we have been taught. Or they are very short-term, which whatever name you want to make it, or trading, or whatever it is. So what is the mix there? And our investors are taking so much risk in that, because I believe there can be FOMO also. So what is the risk appetite? What is the risk profiling which you are looking at investors in now, maybe current scenario?
See, as I told you, right, since our country is a young country, okay, so risk-taking appetite is very high. Okay, there's no doubt on that. Market always was risky, is risky, and is going to be risky. It's only way that how you approach market. Our earlier generation was more conservative. Okay, this generation has got access to information. They have got access to technology. Okay, so they are more open to go and take risk. Leave investing. If you see the other areas, like you have apps available which can provide you trading in crypto. There are apps available where you can go and bet on a gaming, on certain sports which is happening. Okay, so now since everything is available on mobile, this generation knows, or the millennials and Gen Zs of the world, they know how to, approach. Okay, or if you don't allow them investing, they will go and try their hands out somewhere else. Okay, so this is one way. Second is the investing culture in India is growing, and we can very well see that the number of SIPs which is happening and the amount of SIPs which is happening through mutual funds, and this is all coming from retail. So people want to have demat accounts, people want to invest in mutual funds. So that also clearly reflects that people are more aware about how to channelize their savings into trading or into investing. So that approach is growing in India, and I think this is just a start. We are a huge country, 140 crore people. Okay, out of that, only 18 crore demat accounts currently, and that too, if you take the unique number, that unique number would be somewhere around 11.5, 12 crores. So there's a long way to go. And the acceptance of capital markets or mutual funds as a preferred source of destination, the momentum has just caught, and I think this will not stop anywhere. This momentum is going to continue, and we will see the trading and investing journey both growing hand in hand in coming years in time.
So basically you're saying that it's mixed. Maybe people are investing also, and people are taking short-term profits also, depending if they got what target they have in mind.
Absolutely. See, when somebody starts a journey, right? So since, as you rightly mentioned, there is some kind of FOMO that my friend, my neighbor, or somebody on the social media has shown that they have earned certain amounts of profit. So that also is one of the driving factors for them to come into the markets. But with age, with experience, they also start learning that trading was one aspect. Then you graduate and you start diversifying your funds or savings. Some portion goes to investment, some portion goes to trading, and that's how the maturity happens. And as you have more inflow of demat accounts happening, with the passage of time, you will see that the first time users will evolve, they will become investors, and there will be further inflow of new users coming in. So as I said, that your trading base will also grow. Along with that, your investor base is bound to grow, because over a period of time, the new users will gain more experience, and they will start to allocate their savings, and the savings will definitely get channelized to investment products like ETFs, mutual funds, and some portion will also remain for trading.
Yeah, fair point. Also, just one just came in my mind while this kind of investor mix you have, and I'm sure they must be more towards stocks and all that. Are there investors who are adding ETFs also into their portfolios, or still you see that it is more or maybe very minuscule towards ETF, or how's the trend? I mean, from a overall ETF perspective, because ETF also as good as stock market, stocks per se. So,
I think the adoption of our users are impressive, and it's growing. We are more a trader-heavy business, but the way we are seeing our users adopting to products like ETFs, mutual funds, this is very impressive.
Very nice. So, just last question to Jay. With we expecting by 2020, India will become third largest economy, and the per capita income will be somewhere between $4,500 to $5,000. And so, what do you feel that how Indian economy, this sort of growth in Indian economy or demographics which we have, which will help in terms of building the future of broking industry? Would you see that by that time where the industry should be and would be? If you can just add few points.
Yeah, that's a very interesting question. See, we are around 2,200 at per capita. You are saying that if you become double from here, I think the inflection point will come when we reach $3,000 per capita. Post that, I'll see that we will explode. I'd say, because so every ingredient is available. That we become a more inclusive, economy where financial services financial awareness, financial literacy, they will all come into play. Okay, so there is a lot of room for product innovation, because aspiration of a citizen changes drastically when they go into that higher bracket. So right now from 2,200, if we cross $3,000 per capita, there will be a lot of aspirational needs coming. They will have they will be more aware about their savings, about how to spend, how to lead a quality life, how to buy aspirational products, and that we have already started witnessing. Now, if you go to any a first time guy who has got a job for the first time, for him buying an iPhone is not so tough, because they have access to easy credit, and that's how we are going that way, where people will tend to save less and spend more to meet their aspirational needs. Okay, and that will create a lot of opportunities for products into financial services space. I think going forward, even a broking platform, they may also need to think about like whether they want to be in all spaces where a user once a user comes to the platform, he should not go anywhere else. Whether he can have investing, trading, borrowing, creating something for their future, insurance. I think those plays will be the next big move. Once we move to that kind of a per capita income.
Well, so that's an interesting, I think, answer, I must say. Just to summarize, if I say like future is bright, we have to keep on watching this space. I think investors are not only adopting stocks, they are using these platforms for other investment avenues also, like ETFs, mutual funds, as you said. And I think the way Indian economy is growing, I think this broking industry should also grow. But investors should also keep in mind that what they are entering into and what sort of risk appetite they have, whether they are ready to take that much of risk appetite. With that, thank you so much, Jay.
Thank you so much. It's my pleasure.
Insights.
Thank you.
Thank you so much.
Thank you.
All right, thank you so much, Jay, and thank you, Umesh, for walking us through this evolution that we've seen of the broking industry, and how you really see things from here on as well. I think it'll be interesting to see how that plays out. India has over 10 crore registered investors, and the National Stock Exchange had put out a very interesting report just earlier this year, where they were mentioning that the growth from 9 crore investors to 10 crore investors happened very quickly in just a period of 5 months. So you can imagine that the favorable position we are all standing in today as an industry. Now, this is of course just one new part of New India, but this is also something that extends to several different industries, to several different pockets of new age consumption. So our next session is centered on exactly this, on changing India's changing choices. Now, whether you speak of real estate, you speak of travel, you speak of finance, any of these sectors really, the sectors aren't new, but the way consumers want to hold them, the way consumers want to experience them has changed completely. So to discuss this changing choice that the Indian consumer now has, as well as the array of choices that the Indian consumer has begun to want and need, we have a very interesting discussion lined up for you and a very interesting set of panelists. We have Saurabh Devendra Singh, Group CFO of Ixigo, Lata Pillai, Senior Managing Director and Head of Capital Markets at JLL India, as well as Shachindra Nath, who's Founder and Managing Director of Upro Capital. And the moderator for this panel, we also have Mr. Sanjay Patni, who is National Head of Institutional Sales here at Mirae Asset Investment Managers India. Sanjay, it's over to you.
Hey, thank you, Pavitra, for the quick introduction of the panelist here and audience. It's a warm welcome to all of you, because this is an occasion where last 4 years we've been celebrating under the umbrella Innowave for this ETF theme. And I think at Mirae Asset in India, we have been doing this, and our objective is very clear: educate people, because we are developing. There is no doubt about it. So on that note, let me welcome all the panelists to you on this event. And I think it's an interesting panel discussion. And I'm very happy as a moderator, because all three of you come from a very different backgrounds. When I go through your profiles, It's very varied and interesting. I'm sure over the next 40 minutes of conversation, I think audience will be benefited big time on this. On that note, let me sort of reach out to you maybe on the first question, because your profile says you've been an investor, you've been witnessing this company in the IPO stage, and then now you're a senior company executive yourself. How has been your journey? Were you spoiled for choice now, or as an outsider or insider? What's your view on that?
So look, the spoiled for choice, it's interesting. So it started, so if you see when I got out of IIT or IIM, that point of time, going to US was a big thing. Now when I go to campus to hire, I see the choices that people have, and the choices that people have in India has been massive. It's also in terms of the businesses that people are creating over time. So I've kind of attempted to be an entrepreneur a couple of times. I have built up Indian businesses for foreign firms, and I have never seen a better time than right now for India, how things are changing. When I see of things as Ixigo right now, which is we look at both trains, buses, and flights and hotels now, we see the choices that people are making from that level are also varied. So if you see the amount of people who are traveling out of India from, say, an airport like Lucknow or Kannur, you'll be surprised by the growth in these areas. I am surprised when I see Jharsuguda, which I'm sure a lot of the audience here won't have an idea that an airport exists there, and that airport is one of the fastest growing airports in India. Again, the choice that is spreading out across India. So I think it's a great time in that sense for India. I'm happy that I am here at this time. I would have been happier was I here 10 years ago. This world was here 10 years ago. But it's probably the best phase for any country across in India. I've worked in about 5 countries and different stages from developed to developing. But I've never seen a country at this cusp of time where things can completely change over the next 10 years, if done correctly.
You seem to be happy with protectionism, it looks like to me. If you ask me that, a lot of people are returning to India now at this point in time. So that's an interesting thing. Lata, if I were to reach out to you, because when we were talking offline, I think there are a plethora of products now. When we look at from a real estate angle, and you've been a banker too for a long time, you have seen REITs, you have seen InvITs, they have really come out, and now you've seen SME REITs also. That's an interesting, I was just reading about it, and it has given choice for retail investors to participate maybe in a sector like real estate, etc. How do you see that future? Is it developing? Is it already built? Or where do you see a stage?
I say, Indians always loved real estate. I guess in all forms, and when in earlier times it was when you had some money, you bought a piece of land, and as you grew, your affluence grew from the point of view that how many properties do you really own, and increasingly that is something which people did. I guess what advent of products like REITs and InvITs have done is allowed an individual investor who could actually participate in the growth of this particular business or this sector without having to put huge amounts of money, and also not have to worry about managing these assets, because real estate, like anybody who owns real estate knows, it is not that easy to kind of manage it on a regular basis. While it gets you the return, but it's also about how you manage it well, and when do you enter and when do you exit, like every other sector that we talk about. So I think these products that is available, InvITs are of course also available for playing in the entire infrastructure space, right? So I guess be it roads or whatever, which I think a normal retail customer did not have that option before that, right? So I think in that sense, it is the ability for India to participate in India's growth story, actually. So I believe that this is only going to grow. And when we talked about SM REIT, I think again, that is, what they've done is they've looked at smaller sizes. So, REITs, by very nature, you need to have a particular size of portfolio for you to get listed, for it to make sense. I think SM REIT is a platform that has been given to people even if you want to list one building. You can get, it's kind of a concept of a crowdfunding,
Oh, is it? Okay.
but in a property that you can come in. And I think the first SM REIT product just got launched. I think today was when it got listed.
Oh, okay.
So I guess, I think you'll just see a plethora of these kind of products which will keep coming in, and just be talking about choices being available to investors. There you go. You're going to have that one more choice available.
Oh, absolutely agree. I can't agree more, because like you said about real estate getting converted to digitized world,
Yeah.
I think when we go to Bombay today, you'll find hoardings which says World Gold Council is also talking about gold ETF now, not the physical gold. Okay, you'll find that now. I was talking to many investors and tell them, I said, and I come from Rajasthan, and being a Marwadi, we've always seen gold being kept in the vaults all across, throughout. And I see these boards, I actually get a smile on my face. That's an interesting face all the time. Sachin, when we look at today's world of growth versus inflation, etc., around it, easy money is good and bad both. There is no doubt. And I'm sure we have seen RBI governor talking about it multiple times. Obviously, they have red flagged it many times. But you being a veteran of financial market, easier access to credit, I'm sure that will have many advantages and benefits around it, but there will be some risks also around it. So how do you see that trend? Because we are talking about spoil for choices, and that's one thing which will become very critical for it.
Look, I think so this easy access of credit, it's not an all-pervasive phenomena. I keep giving this example. I remember my father was an Oxford scholar. He was a professor in a university, and he was buying a scooter called Priya, I think so in 1997 or 1995. And that scooter, 92 I think, and scooter came after a wait of 6 years. So when at that time you have to book a scooter, and it used to come after 6 years, so as the phone. And when he had to buy that scooter, the day he booked the scooter, he opened something called a recurring fixed deposit. So by the time scooter came, also the recurring fixed deposit matured, and he bought that scooter. Contrary to that, what has happened one day, when my daughter was in school at grade 11, he came and told me that one of the biggest bank in India actually just given her a credit card with a 5 lakh rupees of limit. I said, you have no income, you are still a student. How could you get a credit card? She said, because I'm a big shopper on Amazon, because all household item goes through my account, and because of my shopping pattern, I got a credit card, and my credit card limit was only 2.5 lakh rupees, right? So world has changed, especially in the consumer financing space. When what you call, I would not call it easy money, wherein India is changing. We keep saying Bharat badal raha hai. Badalte Bharat mein, we are becoming from a saver's country to a spender's country. We are not good, purely from social perspective, it may not be very good, but we are more or less becoming like United States of America, because easy leverage for consumption has really become easy. This trend has started right from post crisis, global financial crisis, where in India certain things happened. Demographic change, bureau became settled, what somebody can buy, and today you can buy anything. Right from, one more example, one day my driver came and said that, sir, आपके घर का टीवी बहुत पुराना हो गया, आपको इसको बदल देना चाहिए. आप स्मार्ट टीवी क्यों नहीं लगाते हैं? मैंने कहा, तुमको क्या लेने देना है? बोला, सर, मेरे घर में भी स्मार्ट टीवी लगा है, क्योंकि 400 रुपए की EMI पे आ जाता है. That day I felt very bad and I changed my TV. Because now, so this is what I think is the method of easy credit, which you can buy anything and everything. But that is only for one segment of the market. I think so where the RBI has flagged it off is for the consumption, or what you call retail credit. But there is still a lot of massive market which is still starved for credit. We operate as a UGRO only in MSME financing segment. The total credit gap for MSMEs in India is 90 lakh crore. It's almost $1 trillion, right? And that has happened because, हम बोलते हैं कच्चा छोड़ो पक्का पकड़ो, because all of the MSME in India has been in the kacha economy versus credit is from the pakka economy. And this transition has started happening because of GST, demonetization, formalization of credit. We are through a cycle wherein the retail consumption credit would go down, but productive credit would now go up. And that is needed for India. It is needed for India because we have to generate massive employment. Employment is coming from productive sector, not from purely from consumption economy, because consumption credit also, influences the inflation. And you'll see through this cycle. The world is coming to a balance, right? we were like the world's highest GDP economy around 1,000 years back. We went to we became controlled by Westerners, and they became rich, and now the balance is coming back. And as this balance would coming back, we'll become younger, we'll become more consumption oriented, and we'll rebalance it. So I would say that the way we are looking at things, credit is not going away, neither it is slowing down. It will transition, next 2 to 3 years, it would transition from consumption credit to more productive credit.
Sure, I'll come back to you, but I'll also tell you, I was meeting a client in Bangalore recently, during my last visit. One of the CFO, he is the CFO of a company which is having, say, around 7,000 employees. And primarily the average age is around, say, 25, 26. And that's a phenomenon in Bangalore, being an IT company, IT hub. And this is exactly what he was saying, that nowadays the kids who join, they want to buy even a jeans on EMI. On EMI. Okay. So they want to own an Armani, etc. and all that, and they want to have on EMI. That's an interesting approach, but yeah, dangerous.
The access to information has changed. I come from what used to be a very small city called Banaras, the oldest city. Now, when I go back, that city is no longer the city which I relate to, right? Yeah. Because the same brand, same infrastructure, same kind of restaurant. I try to find, the old gulab jamun, the kachori, the golgappa. But against that, what you get is these big fast food chains. Because once you open your mobile today, whatever is happening in New York or San Francisco is what exactly you see the information over here. So the aspiration is fueled by this massive digitization, which has actually brought people at level of equity. So no longer a small city boy feels that his growth is hindered just because he don't have access to information. And I was studying to even get a form for a competitive exams. We used to travel from Banaras to Lucknow and sometime to Delhi actually. Now that's not the case anymore.
Absolutely, it's all digitized today for sure. An organization of yours, I think we find it have followed an unorthodox approach towards market, unlike maybe the competitors or many other players like this. And you also say that when we read its non-metro locations have been a great focus of yours. What is it that you are trying to achieve through that? Is it again consumerism we are talking about?
There are two parts of the reason. The honest thing on why we started like we started was we as an organization were very poor at raising private money. So when the conventional private equities were throwing money for big dreams, we were not. What happened during that time was something what you mentioned, that the smaller cities, so Varanasi for us is a major market, which is there. So if you go to Varanasi, people will know all the 3 names or all the 4 brands that we have. Now, what has happened there is people's exposure. India is a classic case of demographic dividend. Now, people are getting younger. Initially, we always, as a company, and we always keep that as the first slide in any presentation that we do, which is we want to be customer-centric, which means that we need to give the user what he wants. Giving you an example on this, as in it's slightly off topic, but I'll still give the example, that when COVID was on, everybody else was running away from giving a guarantee to flight or trains or buses. We were the ones who doubled down on it and created products which allowed people to cancel their flight and get a reasonable large part of money back, and people were willing to pay to buy this product. Now, what I'm trying to highlight here is that India, and I think Uber CEO at a point of time made a statement saying that India is a cost-conscious market. I think that's totally wrong. India is a value-conscious market. Indians will pay a lot of money if you show them value, but the value has to be something relevant for them. So when going back to our journey, when we started tier 2, tier 3, it was a blue ocean strategy. Everybody else was taking the easier path. For the first few years in anything that we do, we hardly make any money because it's getting somebody used to the convenience. You talked about the American Revolution. In some ways, if you see, when the middle class becomes the consumption class is a story which is happening in India right now. People have exposure to what they could do with their money, and then they are using it. So we build that trust through our spread. So we are spread across about 2,400 towns across India. About 94% of my bookings would happen, one leg at least, in tier 2, tier 3. The interesting thing what government has also done is, social media has given them exposure on what they can do. The government has made it more accessible, which is the story that we believe will continue going, and it's a start. When discretionary expense starts, and there is nothing wrong or right about it as the credit is. So when your daughter is getting that kind of a credit line, they can spend. Or what you mentioned was also very interesting. For me, it's the best thing. If real estate or gold, it gets into a form which can be picked up in smaller pieces, then you fulfill that need at a lower amount, and then you can spend the rest, which is what is happening, which is, I think, where the three of these connect in some sense, and we are hoping that we continue being big beneficiaries of this.
Selfishly speaking, as a mutual fund executive, I would want people to buy that and hold it. I would
Yes.
use the word, maybe a negative word on that side. Lata, Indian financial market has definitely matured. There is no doubt. It has come where what we saw 20 years back and what we see today is extremely different. We have also seen, like you talked about real estate, we see a lot of managers, fund managers have become, and they started raising money through alternate investments funds. That's one which I would want you to maybe throw some light. Also, and lately what we have seen in the last maybe couple of years, even alternate investment funds have started showing something different towards these REITs as well. What's your take on that? Because I'm sure you must be doing a lot of analysis on it.
Yeah, I guess the demographic dividend, the affluence that is coming into the country, the markets and the buoyancy of that, and the wealth people are making on that. I think all of it is, and the let's put it this way, that the regulator and the focus of the regulator to protect retail customers from the banking side and the non-banking finance companies have probably forced credit products to be not available to certain sectors, right? So it's opportunistic. So basically AIF started raising money as credit funds primarily, and to kind of target to certain sectors which were not getting credit easily from the regular this. And I guess that has kind of grown quite a lot. Yeah. And AIFs are being subscribed to by, I wouldn't say retail investors, but basically family offices and HNIs. Yeah. And that's been the big source, other than institutions which are putting in the money. And it is a structured product in which things are getting done. So credit funds was usually the way that most of the AIFs started off. But I think off late one is seeing AIFs being used or monies being raised to invest into logistic assets or buy value add offices or retail malls and things like that. So I guess and effectively what you're telling your investor is you're going after yield. This particular yield, you'll get this particular rate if you go in for something like this. So the yields there's a range of yields in which it's playing, depending on the risk appetite of the end investor. So I think, again, I think it's a product that is here to stay. The kind of yields and what that can really do, I think that will keep changing. But to answer your question, yes, it's a segment which is growing and it will continue to.
So that also is consumers are spoiled for choices.
Yes.
If I look at this way, no doubt about it, because you are talking about residential, you're talking about commercial, you're talking about logistics assets, you're talking about that's getting changed. So Shachindra, like what you're talking about earlier, how do you see NBFC space overall evolving in this space? Number one. Within that NBFC space, are there any pockets which are looking ideal for growth? How do you visualize that? Because you have a long experience in NBFC space now, and you've been a founder of that company now.
Yeah, very hard. Whenever you ask any question like this, obviously I will promote my own company. It's very hard not to do that. But I'll give you why we do that. So in last 3 years, we have created, almost 10,000 crore business. Starting from scratch, we are, probably one of the largest small business financing company. But actually, why we did that? If you look at the asset classes, so in the credit market only there is two architectures, right? Beside the new AIFs and others, but predominantly it's bank on one side and now non-bank on the other side. Non-bank finance company is not just a phenomenon for India. Actually, US have a specialty finance company big time, while they have large number of banks, much more than what we have in India. But if you look, and banks architecture in India is defined, because they are custodial of people's money. They cannot go in a niche segment. Banks by design is on the credit side has to serve the need of all. They have to do wholesale, they have to do large credit, they have to do mid-market, they have to do consumer, they have to do retail, they have to do SME, because finally public trust money has to be diversified and the regulators design them in a way to do it all. But what it does in that diversified asset pool, certain segment of the market which needs innovation are not addressed by them. So think it this way. I gave you this example of Mirae scooter not getting funded, and now we have world's largest consumer financing company, right? Why we have world's largest consumer financing company? Because somebody decided that this is a market would grow, requires certain degree of innovation, speed, credit, on tap, and integration and distribution. There was a time when, think of this around 25 years back, if I would tell you that there is a driver who have no source of income and want to buy a second-hand truck and want to get financed, you would say why that is possible. Why you'll finance a guy who has no self-earning and is just a driver and you're financing a truck, but a massive large company of more than 250,000 crore got created by just financing second-hand truck driver. Gold, which was an asset, which people will not take out. It was considered to be Istri Dhan, only kept for emergency purposes. So when everything will fall through in your safety net, then you will go and sell gold. But we created massive gold loan companies in India, which because we have been able to promote saying gold is a asset which you have to hold, but you can use that. So all of these massive innovation have happened through NBFCs So my view is that NBFCs are not designed to do things which banks do. So the NBFC which focus on certain niche area, and that could be anything in credit market, and have propensity to scale, would deliver some solving of a problem. Like we are trying to solve the problem of credit for MSME because there is a need to solve that problem differently. Use of data, change of digitization, different architecture of liability, so on and so forth. So NBFC, my view is that NBFCs are here to stay. NBFC which will solve a real problem of credit for an underserved market will do. Same as microfinance company, housing finance company, right? So technically otherwise, if banks could do that, then NBFC should not exist. Banks have all the advantage. They have an advantage of leverage, they have advantage of deposit, they have advantage of, RBI being their, last mile support and all the things. But still NBFCs have been, growing. NBFCs which diversify, at very large scale you have to diversify. But our role is to solve a problem of credit for an underserved market, and any segment which you will do that through a different architecture of product, design, distribution, you will succeed. And such NBFCs should be, very good investment options across the board for, institutions like yours, for retail investors, for, if you want to deploy credit or want to participate in debt, such NBFC would be outlier performance over a, time horizon of 5 to 10 years.
I think in our country, 140 crore people can consume anything, whatever you serve them. I think on a platter, that's the only thing I can think about it. Let me come back to you because what Sachin also talked about, different real estate sectors are performing differently. You talked about residential, commercial, logistics, warehousing, and all that many things which are there. How are the investors looking at the asset classes from, more importantly, somebody can say you can buy, but the patience pays, right? If patience pays, your holding period, your timing around it, is it a good time? And what sectors are you seeing where demand is appearing not cyclical but structural? That's more important.
See, almost all these sectors today, given India's where we are located, we talked about where we are positioned today. I guess tailwinds are there for all the sectors, really. Mm-hmm. However, residential as a sector is a cyclical segment anyway. Very sensitive to the pricing, very sensitive to the interest rate movements, and we've been seeing phenomenal growth in residential demand over the last at least 10 quarters now. It's been constantly, you've just seen the uptake going up, and it's come after a very long time. That's been, the markets have been dull for a very long time, and probably that's the reason. And post-COVID, I think there has been a surge for people to own homes, and I think interest rates were low. Very surprisingly, even after interest rates moving by almost 250 bips, you didn't see a letdown in the demand. So I guess the demand just kept going up. But one needs to always remember it's a cyclical market. It's likely to have that effect. As far as office is concerned, commercial real estate offices are concerned, we as JLL remain very, very bullish about this segment, because we believe that there is still a lot more to unravel here. Because I guess we are moving as a country to be the location of choice for GCCs, that's Global Capability Centers. And a lot of GCCs are yet to come to the country. And when GCCs really come into the country, we are not talking about old-time BPOs. We are talking about actually a level higher in the talent that is there. So what works to our advantage is the talent pool that we have and the cost of real estate at which you can get them. So I guess these are the two things which runs in our favor, and we continue to maintain that competitiveness, and therefore we believe that that story is going to play out for some more time on the commercial real estate side. The logistics space is a different story altogether, because we've just started that business, is what I would say, because grade A logistics space, it's a combination of two things. What the government is doing in building the infrastructure corridor, the kind of stuff that's being done on we're getting the GST regimen coming in, so the tax thing getting clarified. These two are really the two fillps for allowing for that particular business to grow. And institutional holding of logistic assets has just started happening. And when that happens, you will see the quality of the assets, the quality of the occupiers, the rental yields, all of it actually going up. So I believe logistics, we are just starting the growth that we will, you will really see that sector growing quite a lot going forward. Yeah. So I think office and logistics, yes. Residential, one needs to be careful.
I'll tell you an interesting thing there, Lata.
Yeah.
We find even properties are getting sold on digital platforms nowadays. It's actually a big space now. On that note, sort of let me come to you, because you come from a house which is, I would say, probably tech-driven company, no doubt about it. So for you, digitization is a boon for business growth, or there are challenges around it? Nowadays, AI is playing in our life, I'll say havoc or good things, I have no idea. Okay, I still don't have an answer to that right now. Also, being an institutional business, I meet so many corporates pan-India, and I happened to meet someone in Bombay recently, and I found that that company didn't have even a SAP implemented despite having 2,000 crore cash on the books. I have a question there. Is IT infra development, is it an expenditure or an investment? And you come from a tech background.
So I'll answer a part of the question, the first comment that you made. In my opinion, any SaaS company, and maybe I'm not talking my book, I'm talking generally how I see and how we see internally what we are developing. SaaS in general becomes redundant because you can build your own platforms way more easily. So anything that's software becomes way more easy to build right now. So as in, just to dial back a bit, Ixigo, one of the co-founders, he has been an AI guy since the era when AI was known as neural networks, or when it was known as transformer models. So the first AI chatbot that Ixigo would have introduced, and a part of the reason why it became a flight OTA, was the fact that it introduced this chatbot which was solving 80-90% of the queries. Thus, you didn't need a massive team of people to answer customer service. So with that background, if I'm sitting with my AI team, the answer on AI or tech would be that the world is going down, because it's that kind of people who know too much probably are way more negative than I am right now. What I see from where I sit is that I believe anybody who has proprietary data, what will happen is the churning of the data becomes easier now. Building products based on the data becomes easier now. So the two things in this world which you should have to differentiate, one of them is access to your own data, which nobody else has. And the second is ability to understand the user problems and the right problems in this case. Creation of anything internally is now become substantially easier. I was telling somebody just before this that take a case of making an app or technology, say 5 years ago. You needed to have a massive team of senior engineers, sit and make it. Now, if you start doing it today, and I can bet on it, within a month you'll have an app published on the Google Store and Apple Play Store. It's become that easy to come out with things. On investment versus capex, surely investment. So if you see my P&L right now, I spend about 4.5% of my operating income on technology, out of which 2% is what I need to essentially let the existing things run. I'm spending extra over it just because I feel it's like the printing press movement right now. Business models will change. It's still unclear on how it will evolve from here, but what is sure is it won't be the same than what it started with. The problem is still with a lot of companies not embracing things. And security is the other problem. So if you don't understand it fully, it's a security issue. For me, it's easier because my majority of the 500 people that we have are techies. So it's easier shifting. But think of this, if I was still in an investment bank, moving anything is a pain. We were still on probably Fortran in my investment bank because people don't realize they're scared of change. The guy at the top won't really have an idea that the world has changed. So I think it will be a combination, but it's a massive opportunity. So I would think it surely as an investment, the most important investment right now.
On that ground, I can also tell you one thing, that we are about to launch in the month of December a product which is purely new age tech, platform. It's an index, and we are launching an ETF. Just think about it. We are exactly aligned there because we feel, I think it's about to follow that path. No doubt about it.
No, I kind of, with the risk of saying that I'm advertising your product, I'll probably end up subscribing to that product. It's that great a thing to have.
Last without you being an ambassador of that, for sure. Let me put it this way on this side. Sachin, to you, I mean, there have been news around slowing growth. NBFCs have been at the forefront of that, but last 5 years have demonstrated a crazy amount of growth in the NBFC, and they have funded the market. Do you think with regime changing in US, different kind of actions, macro slowdowns, I think is it leading to slower growth for NBFC, or you continue to be bullish about it?
So look, NBFC's growth is function of two things, because we are predominantly funded wholesale. And the behavioral pattern of the banking system and overall liquidity into the market actually is what defines at what growth rate you can do that. So I don't think so. One, India is a still credit-starved country. If you leave aside the retail and consumer credit, for us to achieve the level of maturity, the level of employment, if you have, if by 40-47, if we have to really be a developed economy, India, on an average, needs 25% credit growth across markets. Wholesale, large corporate, mid-market, retail credit, MSME. MSME probably would need around 35 to 40% right? So credit demand would continue to be there. The slowdown in the economy obviously would lead certain segment of the credit market to slow down. Where we think so the retail consumption, because the contribution of inflation, and the consumption demand going down would slow down the retail credit growth, and also the heightened risk of over leverage and other multiple problems being there. But in that, you will still see outlier performance. At this point in time, the way government is looking at it, I keep saying there are three types of political polarization which has happened in India. Two have happened, third is about to happen. First was what we call the caste, creed, religion, geography, right? That when then we took it to a level up, which was more nationalism, religion, identity. But ultimately, all of this would fade away, and the only polarization which will work and which works in all the places is economic polarization. The economic polarization means I have to give you a job, you have to be well fed, and then why you will vote me. Now, governments across what I call the left, right, and center have understood that economic prosperity of people come from employment, and employment is fed by few things. And MSME being, one of the largest employer in the country, the government is pushing that to grow. And that's why we genuinely believe that, in credit institution which we focus on the real employment creation opportunity, whether it's agriculture, whether it's MSME, would continue to grow. So if you look at broad summarization, you will see some slowdown. But that slowdown, our base, when we were growing at 25%, it was insufficient. When we grow at 17%, it is insufficient. When we grow at 35%, then also it is insufficient. So we are living in the market of insufficiency. So whatever we can do, we have to just feed. The problem right now is that credit markets is competing with capital market. Where the problem is that in India, we have not been able to tell, public at large, what we call the balance in life. So we are unidirectional. Now we think that putting 100% money into the FNO and the public market is the only way. There is nobody, to a 25-year-old Bangalore kid, nobody tells that of your disposable income, you have to put money in ETF, you have to put money in FD, you have to put money in capital market, you play some part of FNO. That's why people are just in one direction. That is leading to savers economy becoming consumption economy. Banks are suffering, not having deposits, which means people like us not having enough money from the banks, consumption economy going that. But it's a cycle, I think, so people will change. I can't wish capital market and stock market to slow down because that, leads to other consequences. But I wish that very well. But there is a need to create some balance and create more liquidity. So people start investing in all asset classes, just in one asset class. Once that change would happen, then then you'll see you should create an ETF on the bond market actually, and let people, because the problem is that people don't know which NCD, which bond to buy. Yeah, so if you create a bond ETF in India and let people contribute to that and earn 2% higher than what they get in FD, you will create a new flow of credit to the capital credit market as well.
No, I completely agree, because what Saurabh also talked about, what you also talked about, when you look at today the numbers of gold getting sold online to digital platforms, especially to tier 2, tier 3 and the last mile in the country, on the digital modes have become different. And you also said about gold loans, etc. I think all that is leading to a very different picture in the markets today. And I'd say definitely they are definitely spoiled for choices as well. But let me flip, Lata, towards you, because one phenomena when you find today, I don't know whether it's a post-COVID, maybe you can throw light on that. Residential buying, when I look at prices for the last 10 years, leave aside pre-COVID, maybe 8-9 years, it has been sluggish, maybe, from the price point of view. Today, these millennials who are making so much of money, I always tell them, I said, the moment you join, you buy two things. You buy a car and you buy a smartphone. Okay. But nobody looks at residential buying to me. Are you seeing these kids, the millennials especially, looking at renting or buying a house? Is there a momentum getting changed? And if yes, it is cyclical, or is it sustainable, or it's just going to die down?
See, I guess India per se, while there is this thing about spending on things which are noticeable, in the sense buy the first phone or buy a car or whatever. Absolutely. But I think the basic ethos in Indians is that when you've had the money, whenever you have the money, you will go in and own a home. And that is not any different for a youngster coming up as well. As in when they can get a loan, they can get somebody can consider them as decent credit, you will find them buying home. So I don't see that changing. And it continues to be the trend. I think when you talk about millennials, they're like 25 today, so like it's still early days for them, but I don't see that changing too much. In fact, post-COVID, owning a home has become actually more, people who were actually preferred renting have decided to now own homes, so that's been the thing. And the second thing also is there, compared to the Western world, or even like countries like Australia or Japan, we do not have institutional investment into rental properties. Like you and me will buy a property and rent it out. It's not like a service kind of a business model which exists, and it's a huge business. Multifamily businesses are one of the biggest businesses in the US, Japan, and Australia. So wherein institutions own apartments, maintain it, and you can just come in and rent apartments for whatever period that you want to. There is an ease of doing that, right? That doesn't really exist that way in India. And that also could be one of the reasons. But definitely, to answer your question, I don't see millennials not stopping buying. They will buy when they can afford it.
Actually, if you look at growth of housing finance companies in India, that will give you the trend.
Yeah.
Housing finance companies have been growing at an average CAGR of 15 to 20%, most of them at every base. Actually, what is very unique, once the residential real estate market prices keep going up, people do it for twin purposes. They buy it for consumption, but younger people also see it as an investment option, because they know that while they can, live in the house, but it's also one of the investment which will also grow at a double-digit growth rate. Actually, that is increasing the ownership of the home, and that's why housing demand is growing. So as prices of residential housing, so as the credit demand for housing.
Why I asked this question is, one of the CEO I met recently, she was suffering with a syndrome. She said, whatever I'm buying, assets, my kids don't want it. Okay. She said, my kid don't want to buy a house. Okay. I said, I'll rent it out. My kid don't want gold. I don't need it. That's fine with me. He doesn't want to buy a car. So I have Olas and Ubers of the world you can give me. So today's kids, millennials, have a different behavioral pattern. But if you go on a Monday or a Tuesday, you still find restaurants to be full. That behavior is also.
We're talking about the 1% population and their children. Yeah. That does not represent true India, right? So if you go to a Bangalore campus of any BPO, that is not a son or a daughter of a CEO of a company which is well fed, which is privileged class. That's come from a middle class background from UP, Bihar, and other part of the country, who's well earning now and want to now use that money for better consumption, own house, own gold. I don't think so that 1% represents truly the India.
Though I think where the difference might come, again, we'll all know, as you said, it's just 25 years right now, might come is, our era, people would go in for multiple houses. This era, staying, I understand, but investment, I'm not that sure on buying house for investment in this, as in with mutual funds being now the demat accounts increasing.
Of course not.
You've got a better return theoretically.
Yeah, which is rent versus buy. So people intend to buy even one house.
Yes, and
because they think that it is also a good investment. So why should not do that?
Maybe the tax incentive has done away with. Maybe that's another reason people are dissuading it. At least whatever they're buying, they're consuming it more.
No, there are other ways we talked about earlier. There are other ways in which, if a millennial if he has the money and wants to play the real estate market, there are other products available for them to do that. Sure. You don't have to go and invest huge amounts of money to buy a house, and it's a pretty liquid investment, right?
So Saurabh, I was going through a profile. Okay, I found it very interesting.
It's got a lot of things.
Very interesting profile, and it was fund to the bank, to sports focused advisor, to an equity brokerage house, to and founding a media tech business, to Bernstein, and then finally now with the online travel portal. You have seen the whole journey of Indian consumer behavior. Anything which you want to tell us?
Part of it is driven by a midlife crisis every 7 years, which I suffer from. But having said that, as I said earlier, the fun part of India right now and the consumer right now, take the case of anything, take the case of sports. So sports wasn't in India, but because of sports in UK, and I was in Sheffield at that point of time, saved a club from extinction. But the thing that I saw there in developed societies, so the difference between India and UK, if you go back to say a 2007-8 versus right now, was 2007-8, an average youngster won't have so much hobbies in these kind of, or would be spending money in say sports or concerts or stuff around, as in you did it, but you did it occasionally. Now you go to say, and which is the reason why companies are paying thousands of crores for buying these event companies right now, or event businesses from other companies. So I think that part I see on ground as changing, and I see it with my own book too. So I'll give you an example there. So every day across the 4 divisions we have, we would be selling around 700,000 to 750,000 either tickets or room nights around it. And a 30% of them would be buying something extra, which would be an ancillary product for convenience. Now, if you ask me from my level, had I been a mass example right now, I would have been very surprised. I'm very surprised by this number, because people are paying between 5 to 20% extra for convenience, which is there, which is a sign again on the discretionary, people willing to spend where they are seeing value. And this, I'm not talking about people in Bombay or Delhi, I'm talking about people spread across India. So that's the good or the great part.
Sure, interesting. We're running short of the time, but Sachin, the last question maybe to you. Like I was talking to Saurabh, you had a stellar career of 3.5 decades now across assets and liabilities you looked at, and now in NBFC. What is one development which you're seeing in the consumer behavior today? Is there anything which is worth, this is going to explode, for example?
So, I think so. What has changed? I was in Lucknow last week in a marriage, and there was this haldi ceremony which was happening, and I reached late and I saw a haldi ceremony, both bride and groom together being there. तो ऐसे ये क्या हो रहा है भाई, हल्दी सेरेमनी तो लड़का वाला लड़के वाले क्या होता है, लड़की वाले कर रहे हैं, ये दोनों साथ साथ क्यों हैं? देन थोड़ी देर बाद उसके बाद मैंने देखा कि संगीत हुआ. हमारे टाइम में अगर होता भी था संगीत, पहले तो ऐसे कुछ होता नहीं था, वहाँ पे भी लड़का लड़की साथ में डांस कर रहे थे, राइट. उसके बाद जब वो लड़की शादी में आई तो हम सब स्टेज पे फ़ोटो खिंचाते, तो उन्होंने बोला नहीं, ये सामने जो 2 ड्रोन से वो फ़ोटो खींचेंगे, स्टेज बिल्कुल लड़के लड़की के लिए खाली होगा, राइट. तो मैंने बोला ये सब क्या हो रहा है? तो फिर मैंने पूछा किसी से, बोला आपको देखा नहीं आपने, मुकेश अंबानी जी ने अगर अपने बेटे की शादी जैसे की, तो ये हम क्यों नहीं वैसे ही कर सकते हैं, इन द सेम पैटर्न. सो दिस इज व्हाट हैज चेंज्ड ऑफ द कंज्यूमर बिहेवियर. टुडेज कंज्यूमर डजंट फील or believe that it is less than anyone else, because it has these things that it cannot spend same amount of money, it cannot do marriages for 1 full year, but at least it can do 3 days, it can it can take a hotel somewhere and do all of that. Today's consumer is competing with anything and everything which is available in the world within its disposable income. This is a new India, new trend. This is fueling the credit, this is fueling the consumption demand, this is fueling everything, because the fear that this is not for me is in today's generation not there at all. You go to malls, you go to 5-star restaurants, you go to the airport, every type of people would be there, right? So this airline is no longer a privileged class. Airports are no longer as privileged class. 5-star restaurants are not for privileged class. Everyone want to have everything. This is the new India, and good, bad or ugly, but people are super confident that they want to own it all. This I have never seen before.
That's an interesting thing. That's called Viksit Bharat, maybe on the 8 cards. But so before we close, let me ask a quick question, and I don't have time. We have maybe 3, 4, 5 seconds to answer that question. Maybe in one word if you want to answer that. Personally, one favorite consumer theme for investment. Lata, over to you. Any one sector or theme which you feel from a consumer?
Equities.
Equities, okay.
I would say travel, but then I'm biased. I think experiences in some sense, not my experience, as I said, which people are buying as in not moving and getting given stuff. So, yeah.
I would like to say credit, but I would say that buy anything which is providing credit is the best bet, because credit fuels all consumption economy. Buy any bank, buy any NBFC, buy anything, but you have to stay a little longer. That's the only caveat. Credit market and banks, NBFC, and all of that can't double your money in 3-6 months' time. Further, there are other avenues which are available there. But actually, that is one of the best themes to buy.
After seeing the Coldplay stick itself, my views have completely changed in life, I think. And now with Diljit's show, etc., I think, in my view, if I were to say, today's time is not about, in financial world we say cash is king. It's not only that. In my view, consumer is king now. It looks like to me, he's truly spoiled for choices. So that's the only thing I can encapsulate in what all of you are saying, and I think thank you so much for all the views. I think these are all wider possible views across segments and sectors. I think thank you so much for audience for listening to us, and I think it's a great conversation with 3 people carrying 100 years of experience plus, and I think they can't be better, from starting from tier 1 to 2 to 3 to 4 city. Thank you so much everyone for the call. Thank you so much for listening.
Having us.
Thank you so much.
That was a really engaging chat on all of us as consumers, being spoiled for choice like our panelists just mentioned. So thank you to all of our panelists. Thank you, Sanjay, for taking us through this chat. And it makes it very clear that no matter where you look, the Indian consumers' spending habits, have forever been changed. That's not something that's going away quickly. Since we're talking about a new and growing India, I think that we should spend some time now also on, the bigger picture, on the macros, the economic landscape as we see it today. So we're currently the 5th largest economy in the world, and the expectation is that we're going to grow to the 3rd largest. This is by FY 2030. Now, India, of course, has a lot going for it. We are the most populated country in the world, accounting for 18% of the total world population. We also have one of the largest and highest working age populations. And this big demographic advantage will likely remain in place for another 40 years, as estimated by the United Nations. Now, with a growing middle class, of course, there are a lot of ripple-down effects that we do see. We also have a growing ability to spend on discretionary items. We are already seeing this change, take place in many, many different parts and in customer behavior. But let's not forget, we are talking about the Indian economy at a time when the inflation challenge is very real. We have been talking about that. Growth for the second quarter, the GDP data has just come through, and it's been quite a shocker at 5.4%, well below even the RBI's own estimates. So how does the growth outlook really look for India now? Are things still intact when you zoom out, you look at the longer term picture? And will this second quarter GDP figure really serve as some kind of call to action on the policy front? Let's hear it from Neelkanth Mishra, who's Chief Economist at Axis Bank. He's also the Head of Global Research and Whole-Time Director at Axis Capital, to talk about how he sees the outlook for India from here on and the rise of new economies.
Hello everyone, I'm Neelkanth Mishra. I work as the Chief Economist of Axis Bank, and I also head Global Research for Axis Capital. I'm grateful to Mirae for giving me an opportunity to speak at such an August occasion. I'll start with a discussion on the economy and then move to opportunities in the market. The first half of this fiscal year, we have seen a very sharp slowdown in the economy. Many high-frequency indicators have shown a weakness. There are now questions being asked on what's going to happen to India's future growth projections. We believe that the growth slowdown that we have seen is a cyclical one, and that the structural trend growth of India at about 7% annually is something that can be easily sustained. Why have we seen the first half slow down? There have been several reasons, but the two major ones are an unintended tightening of fiscal conditions and an unintended tightening of monetary conditions. So let me start with the fiscal situation. In the first half of this fiscal year, the central government has incurred only about 29% of its full year fiscal deficit target. The 10-year median, so on average, the government ends up incurring about 62%. So there has been a 33% of full year fiscal deficit that has not been incurred. So as we all know, an increase in fiscal deficit supports growth, a decrease in fiscal deficit slows down growth, and therefore this has resulted in a significant slowdown. Given that the full year fiscal deficit target is about 4.9% of GDP, 1/3 of that, of slippage, about 1.6% incurred over a 6-month period, is something that can be a significant headwind to growth. The converse of this is that the second half, as the government picks up its spending, should mean a significant revival in the growth momentum. We've already seen that in October. So the gap that was 33% in the first half is only about 17% in the 7-month period. So there has been a significant pickup already in October, and from what we gather, the government is well on track to meet its full year fiscal spending targets. So we should see a very strong revival. On most measures, the high frequency indicators are now showing pickup and that the economy clearly bottomed in October. How close we get to the March 2024 types of growth rates will then depend on the second factor which has driven the cyclical slowdown, which is the monetary tightening. So as we all know, the Monetary Policy Committee has a target of headline inflation, 4 ± 2%. With headline inflation still close to the upper end of that target, there is no way that they can cut interest rates. But I think what the economy is facing is a slowdown in money creation. So there is a cost of money, which is the interest rate, and there is a quantity of money, which is the amount of money available in the banking system and in currency in circulation. Over the past 1.5 years, the money creation by the central bank, so as we all know, money is created either by the central bank or by commercial banks. Central bank share of money creation had slowed very sharply till about June, July. Till March, April of this year, which is 2024, the commercial banks were creating a lot of money. So as banks give loans, they create deposits. Now, when the central bank started getting worried about some banks' loan deposit ratios becoming very high and started warning some of the banks slowed down credit, and what that resulted in was a very sharp slowdown in overall credit growth. So as the credit growth slowed down, so did deposit creation, and therefore the economy saw credit growth slow down from about 16-17% to now 11-12%. So this level of monetary contraction, or at least the growth or the negative credit impulse, is something that has also resulted in the growth slowdown. Starting July, the central bank has put the overnight liquidity into surplus. We have also seen in the recent Monetary Policy Committee meeting that the cash reserve ratio has been brought down. So it used to be 4% for most of the previous decade. It was moved up to 4.5% in 2022 when excess liquidity was being drained off. So this had created some structural issues in the process of money creation in the economy. Now that this has been brought back to 4%, and the banks now have a much more room to start thinking about credit growth in aggregate, we should start to see some improvement in the credit impulse. So what was a very strong negative credit impulse should also now start to reverse. The bigger question is how quickly we can get the overall credit growth back up to 16-17%. That may take longer, and which is why I think the reversal to the trend growth may not happen for the next couple of months. But we do expect that by March, April, the high frequency indicators will start showing a much stronger economy. So as we run into FY26, which is the next fiscal year, I think the likelihood of growth being close to 7% is very high. Why do we expect credit growth, the overall economic growth to be 7%? Why is that the trend growth? it is helpful to break it down into three parts. So there is labor input, there is capital input, and there is total factor productivity. So as we all know, India's total workforce is about 55 crores. We are adding, give or take, about 1 crore people every year. So that's about a 2% increase. There is also an improvement in the quality of workers. So the average number of years of schooling is continuing to go up. And therefore, the input of labor is actually growing at 2.5 to 3%. The labor force participation rates are also picking up, which is also supporting that level of growth. About half of that goes into overall GDP growth, and which is why 1.2% should be the contribution of labor to the overall GDP growth. Total factor productivity growth is how efficiently we are using labor and capital. There also, because of continuous reforms of several innovations, like we will discuss later as well, the innovations in digital public infrastructure, the new layers that we are building, like on top of things like UPI. We are improving hard physical infrastructure. We are giving very significant amount of micro infrastructure at the household level. The penetration of internet, broadband internet is improving significantly. Access to dense forms of energy is improving. The government is progressively ceding space to the private sector, and the private sector is a much better at utilizing labor and capital. So the TFP growth of about 1.5 to 2% a year, which is among the fastest in the world, is also, I think, very likely as we think over the medium term. So there's about 1.2% input or growth coming from labor, about 1.5 to 2% coming from TFP. What's happening to capital formation? Capital formation was slowing down even the pre-COVID period. So between 2012 and 2019, the last year before COVID, capital formation had started to slow. The primary driver of that was actually real estate. So you will hear a lot of comments on how private sector capex is not picking up or picking up. So there's a lot of debate now starting to happen. But actually the prime driver of the slowdown in capital formation in the pre-COVID years was real estate. Real estate spending by households had fallen by as much as 5 percentage points of GDP. So overall investment to GDP ratio went from 34% in 2012 to 27% in 2021. It has now rebounded to about 31%. In our view, it is going to rebound back to 34% in the next 3 to 4 years. And the reason is that the real estate cycle has finally turned. It is driven primarily by inventory cycles. So there was an excess buildup of real estate in the 2012 to 15 period. Prices for real estate had gone very high, and therefore there was an element of affordability which had gone negative. Now with real estate prices kind of flattish and grown very marginally over the past 7-8 years, and incomes have grown, and therefore houses are much more affordable. We have seen the housing sales volumes pick up very sharply. As those houses now start getting constructed, GDP will also be boosted. A second major driver of the capital formation slowdown was the power sector. The power generation capacity is one of the most capital intensive projects in any economy. In India, we were in the 2010 to 16 period adding significant amounts of power generation capacity, perhaps too much of it. And that meant that utilization levels went down. Several of the power companies went bankrupt. Now, this is sort of filling up. So, average utilizations are in the early 70s. At peak levels, we are starting to hit late 70s and early 80s. And at that level of utilization, you start to see new demand for power. Now, therefore, power capacity additions are starting off. And in addition to several new areas like, say, green hydrogen, robotics, data centers, a lot of defense expenditure, which is now starting to get done by the private sector. So this is all driving a lot of capex. In our view, the revival in the real estate sector should also boost demand for cement and steel. Prior trends say that when the real estate cycle is on an upturn, cement and steel volumes grow at 8 to 10% a year. When the real estate cycle is in a downturn, the volumes grow at 4 to 5% a year. So as we start to see an upturn, we are already starting to see cement and steel companies announcing capacity expansion projects. And some of them are actually borrowing and spending as well. So when you put all of this together, about 1.5%, 1.2% growth in capital, 1.5%, 2% growth in TFP, and 4+ growth that can be contributed by a jump up in capital formation should mean that the economy should be able to deliver about 7% growth over the medium term. The challenge, of course, is that this has to be sustained by the fiscal and monetary policy providing adequate support, in fact, not being too much of a headwind or too much of a tailwind. So there will be some cyclicality. So what we have seen in the first half this year is a bit of a slowdown. And as the fiscal and monetary headwinds turn into tailwinds, I think the economic growth should start picking up again. What does it do to the markets? So there are several interesting things that are starting to happen. As we have seen in the last, I would say, 7-8 years since demonetization triggered the SIP business and significant inflows into the stock markets, we have seen demand for equities from Indian households grow very steadily and very solidly. In our estimate, in FY25, which is this fiscal year, the demand for equities all put together from SIPs, non-SIP mutual fund flows into insurance companies, from AIFs, from PMS, all of that put together should be upwards of 6 trillion rupees, 6 lakh crores. For a while, the demand for equities was much higher than the supply of equities, and therefore the prices for equities started to go up. So as we would expect in any market, if supply is constrained, demand is too strong, prices go up, and that triggers new supply. Now, the supply has now started to pick up. So this year, we have seen a significant jump in not just the IPOs and QIPs, which everyone tracks, but also block sales or sales by promoters and venture capital investors in the block market. And the block deals, the volumes have shot up. In our estimate, the total supply could be about 7.8 trillion rupees, 7.8 lakh crores. So what has happened in FY25 is that supply is now starting to be much ahead of demand. In October, this was exacerbated. So what happened was, as FIIs net sold about $10-11 billion in just 1 month, anyway the inflow into domestic funds is close to $6.5 billion. So there was a net outflow because FIIs are pulling out and the domestics institutions could not buy enough. In addition to that, there were several large IPOs that were conducted. In our view, in the next 12 months, the supply of equities will remain robust. I would expect anywhere between 7.5 to 8 lakh crores again to happen. And our fear is that the demand for equities will be slower than that. So one of the reasons why the price to earnings multiple had been going up so steadily and India's premium had expanded, India's premium to world had expanded, I think will now start to sort of taper off. The second reason why we had seen a very sharp jump up in the price to earnings multiple was that the GDP growth itself was getting upgraded. So back in January 2023, consensus expectations of growth for India for FY24 were 5.5%. There was some even at 4.8% growth. As we all know, over time, this was upgraded. We started to see upgrades cross 7%. In fact, eventually 7.8% growth was delivered. On that higher base, the growth projections for FY25 were upgraded further. So as economic growth projections were upgraded, the FY25 output itself, the level of real GDP, was upgraded by nearly 3.5%. In nominal terms, given that inflation also surprised, there was a 6 to 7% upgrade to just the total output of the economy. You can expect what that did to earnings growth, and therefore markets which tend to extrapolate also projected this forward, and that generally means that PE multiples go up. Now that the growth upgrades have kind of stagnated and we have seen a bit of a correction because now downgrades have started, in our view, we should go back to the 7% kind of growth level, and therefore I think the PE multiple is something that I don't expect to fall meaningfully from here. but we can see some kind of a time correction as the earnings start to catch up. But if the GDP growth picks up, and I think it will, as at about 7%, with headline inflation remaining in the 4.5-5% range, a low teens growth in EPS is very likely. And therefore, as we think about the medium term, if the PE multiples remain constant, or even if they correct marginally, double-digit returns from the stock markets appear quite likely. The new listings also provide new opportunities in the sense that we are seeing a significant expansion of the quality and the type of companies that we get to invest in. There are already more than 600 companies in India with a market capitalization of over $1 billion. For stock market investors, this presents a significant improvement in diversity. We are also seeing many new types of businesses emerge. In the last 3 years, 4 years, we have seen new categories emerge, electric vehicle manufacturers, internet companies. And as we go forward, some of the early stage unicorns are now starting to appear in the public markets. And that provides excellent opportunities for investors to participate in this. What are the risks? The risks are, I would say, fourfold. The first big risk, in my view, is that this is going to be a phase where income inequality in India rises. As income inequality rises, because this is a phase where labor is in surplus, capital is in shortage. So any economy that has gone through this phase, be it Japan in the late 19th century after the Meiji Restoration, or Europe in the early 19th century, US in the late 19th and the early 20th century, China till about 20 years back. See, all of these economies have seen a surplus of labor and a shortage of capital, and that tends to exacerbate income inequality. We are going through that phase right now, but this in a democracy like ours creates new types of pressures. Most economies that went through this phase did not have universal suffrage because they went through this 150, 200 years back. The countries like Taiwan and Korea, which went through this phase, were dictatorships when this happened. This is something that could be absorbed by such regimes. In India, the policymakers need to be very careful about handling this phase of growth, because otherwise the policy shifts can start reversing. The second meaningful risk is what's happening to the global cost of capital. What we are seeing with the new Trump administration is a further push towards American exceptionalism, that the fiscal deficits could actually go up further. Inflation expectations have started to go up, and I think the government, as it starts to project its new fiscal targets or starts to extend the tax cuts, which is what the promise has been, we could see a further increase in the 10-year bond yields in the US. As we all know, that sets the cost of capital for the rest of the world. So as the 10-year bond yields start to rise, there'll be many parts of the world which will start suffering. We've already seen some of the smaller economies in Latin America and Africa with this recent surge in the US Treasury yields start to suffer. In our own neighborhood, countries like Sri Lanka and Pakistan have been suffering the last several years because of the elevated cost of capital. This is something that in India we need to be less worried about specifically, but this does slow down global growth, and which is the reason why I think that 7% trend growth will struggle to be 7.5% to 8%, because the global growth is actually going to be constrained. The third big risk is China. So China, for a long time, was investing its high levels of saving into real estate. Over the last 3-4 years, as the policymakers have shifted attention away from real estate into industrial capacity, they have created excesses. So there is China's share of global manufacturing continues to rise. Again, given that India does not have that much of a strength or that much of a presence in global manufacturing, it is not something that hurts us immediately. As we have seen, European auto manufacturers are firing people. There are now problems emerging in Indonesia, in Thailand, in Latin America because of dumping from Chinese manufacturers. In India, we have actually a revival happening. I think finally in some sectors, China plus one is actually starting to work. We are missing many opportunities, but there are many that we are grabbing as well. But the China's growth actually slows us down further, which is why I think that 7% is, I think, again, going to be harder to get to 8%. The last big risk I see, which is more a medium to long-term risk than a near-term risk, is the underinvestment in urban infrastructure. So in India, we have learned how to build national highways and railways, but what we have struggled to do is manage our cities better. For those of you who have seen Mumbai after the coastal road and metro rail, would vouch for how remarkable it feels to be able to traverse distances more efficiently, how many more meetings you can start to do. And this needs to be done for 500 to 1,000 cities. The sooner that policymakers can address this lacuna, where urban centers start to get a bit more of funding, the faster and the certainty that we'll be able to sustain 7 to 10%, 7-8% growth over the next 8 to 10 years. So to summarize what I said, the economy has slowed down in the first half. We have seen growth slow down, but it was a cyclical slowdown due to unintended tightening of fiscal and monetary conditions. On the fiscal side, we have seen the easing already begin to happen, and as the fiscal year progresses, we will see a significant pickup in spending, which would boost growth. On the monetary side, the easing process has started. It is a more gradual easing than on the fiscal side, which is why growth revival could take another 4 to 6 months. But we should see high-frequency indicators improve. Trend growth assumptions in India should remain at about 7% because of 1% input or growth because of labor input, 1.5-2% because of capital, and 4.5 because of TFP, and 4.5 because of capital formation. So on the market side, the incessant expansion in market PEs, which had also driven quite a bit of froth, is something that, in our view, should be now behind us because supply of equities is starting to catch up. We do expect a steady increase in demand, but the supply is, I think, going to remain robust. What the supply also does, though, is provides much more liquid markets and also provides much greater diversity and variety of options for investors to choose from. So with that, I will stop, and I thank Mirae Asset again for this opportunity to address you. Thank you.
Thank you for that, Mr. Mishra, for laying out so clearly and taking us through how the next 5 years could look as we move towards becoming the third largest economy globally. Now, what really stands out to me is that while age-old sectors like industrials, manufacturing, construction, these aren't going anywhere, but we have a whole host of new contributors. So take a look at some of the recent IPOs. Like Mr. Mishra was mentioning, these are from categories that didn't even exist a few years ago. In fact, the change is visible in day-to-day life too. The Indian consumer spending towards discretionary items has changed rapidly. As per the latest household consumption expenditure survey, 54% of rural India and 61% of urban India's spend is on non-food items. This is why pockets like hotels, travel, retail, quick commerce, asset management, among of course many others, have started to see such high interest. Now, as an asset management company, we have decided to bring all of this, of course, back to the market. That is why we have a dedicated team that is constantly looking at capturing new trends and, getting in on all of these stocks, all of these sectors and pockets. Over the years, we have tried to create unique products, differentiated products, and give you as an investor a way to position yourself in multiple different areas. So we have, for that purpose, tested several different strategies. We have tracked the growth of sectors and themes, and then worked to create products that, we expect will stand the test of time. To speak about the big ETF product landscape and the focus on innovation here at Mirae Asset Investment Managers, we have Siddharth Srivastava, Head of ETF Products and Fund Manager, who is joining us now for a quick address. Siddharth.
Thank you, Pavitra. Good evening, everyone, and thank you for being part of Innowave 2024. Today, in my presentation, I'll be talking about evolving ETF product landscape and usage of ETFs. Now, when the ETF journey began, the entire conversation was about active versus passive. Even today, people invest in broad-based indices because typically most of the active mutual funds are struggling to outperform benchmark on a consistent basis. Since 2010, in almost 8 calendar years, Nifty 50 gave higher performance than the average performance of large cap funds. The conversation then shifts to lower cost of ETFs. For example, Nifty 50 ETFs are typically available at just 0.05% from a TER point of view. Even an average direct large cap plan is around 89 basis points, which is significantly higher. But as ETFs become more and more prominent, people start to realize its other usage. For example, people start looking at ETFs from a portfolio placement point of view. A strategy ETF based on smart beta indices, thematic ETFs which can provide access to disruptive and emerging themes, and sectoral ETFs which can provide a very good tactical or strategic exposure in your portfolio. And this is how we are seeing ETF market evolve in India, similar to what we were seeing globally. For example, typically when we talk about ETF, it's always about core allocation, right? The first conversation is always about core allocation. But then globally, almost 72% of ETF usage is for tactical adjustment, depending upon your view of the market. Around 57% of usage is around portfolio completion. For example, you might have a good exposure to top 50 blue chip companies of India in your portfolio, but your allocation towards next 50 large cap companies may be on the lower side. You can use a next 50 ETF for portfolio completion. Then it is widely used for international diversification also, like through S&P 500 top 50, FANG, Hang Seng Tech ETF, etc. And then for the purpose of rebalancing. If a regime is changing, if there's a shift in the market, you can use ETF to properly rebalance your portfolio. In last 5 years, we have seen the product landscape change to provide such plethora of options to Indian investors. For example, you have Nifty 50 and Sensex ETF for broad-based exposure, but you have a Nifty Bank or a Nifty IT for a sectoral exposure. You have themes like consumption, manufacturing for thematic exposure, but then you have presence of a FANG Plus ETF or a Hang Seng Tech ETF for international exposure. Going into more specific, you have Alpha ETF for a bull market exposure and a low volatility or quality ETF if you want to position your portfolio for bear markets. So depending upon the necessities and requirements, you have now products in place in the Indian ETF market. And that is what is making people so bullish about ETFs. If we look globally, there are over 11,000 ETFs in the market, having an AUM of more than $14 trillion. In US, in fact, the AUM of passive funds is more than the AUM of active funds. And are we seeing similar trends in India? The answer is yes. From a mere 10% participation in March 2021, we now have over 17% of market share capture by the passive industry altogether. This is solely possible not only because of the presence of broad market schemes, but also because of innovation which is taking place in the passive industry. We are seeing increased participation from corporates, from HNIs, and now finally from retail also. Retail has taken a huge step to participate in unique products, be it on the theme side or on the strategy side. For example, one such segment which I'll be talking about is smart beta. Now, smart beta is all about merging the best of active investment and passive investment. Active investment started way earlier, and it was all about capturing market inefficiencies and trying to outperform the benchmark based on certain factors and fund manager analysis, which can be based on technical parameters or fundamental parameters or mix of multiple methods. Passive, on the other side, was all about replicating the market, like Nifty 50, like S&P 500. And then people thought, why not create a passive fund which is basically based on a certain strategy or a certain characteristic. For example, instead of choosing companies based on market cap, choose companies based on factors like alpha or momentum. Even weigh company based on alpha or momentum. And in this manner, the product will typically try to capture the bull run of the market and will typically, in good times, outperform the market. Here, typically, your product will mirror the investment objective and risk and return aspiration of a particular investor. Now, there can be several types of strategies, and all of them are pretty intuitive. A strategy like alpha will work in a bull market, whereas strategy like a low volatility, where stocks are picked based on their price stability, will work better in a bear market. Similarly, value works better when markets are recovering. Quality again works better in a bear market, where stocks are selected based on higher profitability, lower leverage, and earnings consistency. And these are the set which is providing investor with so many options to invest in passive product, which is aligned with their investment objective, which is aligned with the returns which they are seeking and the risk which they are targeting. And typically, when we look at passive ecosystem, we think about Nifty 50 and we think about a particular risk and return profile. But the market has already evolved. Mid cap and small cap has a different risk profile and return profile, right? In last 5-7 years, we have seen that. But using smart beta, if you are risk averse, you can look at low vol or quality, which typically does not compromise on returns, but certainly has lower risk in the long run. If you want to have a higher risk because you want higher returns in the long run, you can look at alpha or value, which historically has generated higher returns over the benchmark, though with higher risk. But then you can combine multiple factors to get at a more desired risk and return profile and to remove the cyclicality which we typically see with alpha, momentum, or low volatility. So while we always thought that passive is all about Nifty 50 and Sensex, the passive playground has increased, widened significantly. You have plethora of options across the return and risk axis. Now, you can combine these options also. And that is what is actually becoming popular. You see, passive is not about taking exposure in a single ETF. Your ultimate aim should be to create a very robust portfolio. And using smart beta ETFs, you can attain a very good risk and return profile where the cyclicality can also be reduced of your portfolio performance. For example, if you invest simply 50% in a low volatility based ETF and 50% based on alpha ETF, you'll typically see in the long run the combination outperforming a Nifty 50 index and even a large cap fund category or large and mid cap fund category. This is something which is becoming very popular. People are using combination of smart beta funds to attain a desired portfolio. This can also be reflected how well smart beta has grown. For example, in 2020, October, the size of smart beta category was just 400 crores and it has increased to almost 35,000 crores in passive industry. The best thing is that while we are seeing a significant corpus going towards momentum/alpha strategy, which has a total AUM of around 14,000 crores right now, but you're also seeing investments in low volatility. You're also seeing investments in multi-factor strategy, which just highlight how well investor has evolved, that they are able to pick out multi-factor and low vol products also in this bull run because they know which product can provide them the right risk exposure, which is very important when it comes to investment in these smart beta products. Now, right now we have lineup of 4 smart beta products. One is Nifty 100 Low Volatility 30 ETF, which basically captures stocks which are more stable, portfolios typically less risky. And if you look at long-term performance, it is a percentage or so higher than Nifty 50. The next one is Alpha 30 ETF, which is high risk, high reward strategy, where you're picking stocks which are doing well recently. Next two are multi-factor strategies. We have India's first multi-factor based on small cap universe, where stocks are selected based on liquidity, quality, and momentum metrics. And then we have India's first and only mid and small cap product, where 50 small cap stocks and 50 mid cap stocks are selected to form a 100 stock portfolio. And here also, the selection is based on liquidity, momentum, and quality. Now, in the second part, I'll talk about thematic ETFs, because that is where we see next run coming in ETF industry. Whenever we talk about thematic products, we think about traditional themes like manufacturing, infrastructure, consumption, BFSI, and all of them are currently captured, and an option is provided via passive products. And the beauty of these passive products are that these are method-driven products. You know what you're getting into. A typical consumption-based ETF will tell you how a portfolio is constructed, how stocks are selected, and what has been the performance in past decade or so. And all this comes at a lower cost and without any active fund manager risk. Now, second set of themes which are getting popular is focus themes. For example, within BFSI, one might be bullish on private banks right now because they haven't run up as much as other segments have. But someone else may be bullish on PSU bank segment, which still hold certain promises. And you can have exposure in these focused segments again through ETFs. The third segment, which is getting very popular in themes, is forward-looking version of traditional themes. What do I mean by that? For example, instead of a broad consumption fund, a passive product can be created which only targets, let's say, a consumer discretionary segment. Within an auto segment, right now products exist which targets electric vehicle segment. Within energy, a passive product can be created which targets green energy segment. Again, providing investor a more forward-looking version of a particular theme. And lastly, new themes can be created which focuses solely on new disruptions. For example, we have a product which invests in companies which are at the forefront of artificial intelligence and technology globally. Now, these thematic products can work wonders in your portfolio, and you can use them in multiple ways. If a theme is scalable, broad enough, it can form part of your significant part of your portfolio. But if you want to take a tactical call, you can also invest in focus theme like I mentioned. If you want to invest from a 5-10 years point of view, you can look at themes which are capturing new disruptions or are forward-looking versions of traditional themes. Now, from a thematic point of view, from coverage, we currently have themes on the traditional side, like India manufacturing, financial services, IT. We then have focus themes like Nifty Bank, PSU Bank, Nifty Metal. Then we have a newer version of traditional themes like EV and new age automotive, ESG sector leader, and we are going to come out with NFO on new age consumption and select IPO theme also. On the disruption side, we have artificial intelligence and technology, like I mentioned, global electric and autonomous vehicles. And then we have two very unique products on NYSE FANG Plus, as well as Hang Seng Tech Index. Now, very quickly, Swaroop has already mentioned about our global ETF footprint. We right now manage globally around 600 plus ETFs with an AUM of almost $141 billion. We are present in 11 countries. And in India also, we are growing now with a good pace. We started our journey in 2018. Right now, we have a total AUM of around 18,000 crores if we add the fund of fund also. But if we look at only ETFs, our AUM is around 12,500 crores, around 1,200 crores on the index fund side. We manage 25 ETFs and 7 index fund right now, giving investors plethora of options across broad markets, sectors, themes, strategies, etc. Now, like Swaroop mentioned, it is not just only about products. It is also important to provide an efficient and effective manner on capital markets, on stock markets, buying and selling options to the investor, which is why we have our own sister concern, which is Mirae Asset Capital Markets, which provide liquidity in all our ETFs on the exchange, and in case of domestic ETFs, without any additional spread. So even on the most volatile of days, you will see Mirae Asset ETFs trading around the real-time net asset value without any additional spread. And this can be simply checked by looking at INAV and the pricing of our ETFs on the exchange. So not only we are coming out with decent products, but we are also ensuring that on the capital market, our products are priced efficiently and effectively. Now, this is the entire product basket which we have right now on the international side, on the broad-based side, on the sector theme and smart beta side, and finally on the debt and commodity side. If you want to know more about any of these products, please visit our website and we'll get to know more about how each of these products are working. Now, the final slide, and I'd like to conclude my presentation by saying that market efficiency will make passive relevant even in mid and small cap space also. And we are already seeing that. If we look at the performance of active funds in last 1-2 years, you will see that passives are becoming relevant in spaces apart from large cap categories. It is hence time to look also beyond plain vanilla products and explore opportunities through smart beta funds, which can cater to a certain risk and return profile, and to thematic ETFs, which can target opportunities across sectors. I think ETFs are going to play a significant role in model portfolios. They will play a big role in investor portfolio as a portfolio completion tool. We'll see combination strategies like alpha plus low vol being used more and more widely. And new thematic ETFs will allow investors to take exposure in new age economies, emerging disruptions, and in a way provide alternate view of investments in very traditional segments also. So that's it from me. Thank you for joining us for Innowave 2024. It has been a pleasure. It's over to you, Pavitra. Thank you.
right, thanks a lot for that, Siddharth, for really talking to us about how ETFs are now focusing on innovation and how this is a tool that you can put to work in any possible pocket. Now, Siddharth was mentioning smart beta and how in just a couple of years, this has grown to a 35,000 crore market cap. What this shows you is the appetite for differentiated products. The small retail investor as well as large family offices have both been very, very quick to get in on this factor investing wave. You also mentioned that the next wave of innovation is happening in the thematic space, where products are being developed to capture, either new trends and industries which are both emerging in India. Now, there's been such high growth in the investment landscape overall, if you look at it in our country. In 2019, 5 years ago, for a stock to qualify as a large cap, it needed to have a market cap of 28,000 crores. That number today has grown almost 3 times to 85,000 crores. Similarly, there are 500 companies with a market cap higher than the 2019 cutoff for mid-caps. And of course, as is common during a bull run, we have seen a slew of new IPOs come in, and there has been a very, very hot public market. So for a growing economy, for a growing public market, we now have a growing suite of products that you can play. Now, India is a growing economy, but it is also, like we've mentioned, a changing economy. A large number of urban youth has gotten so used to ordering any meal that they like at any time that they like. We need our groceries delivered in 10 minutes. We want, homegrown fashion labels, but we also want every possible international label out there to be available to us. And this is really the face of changing India. We want to go on more holidays, we want more experiences, and this is a consumption pattern that has truly become ingrained in all of us. As an asset management company, we here want to help you identify all of these themes and of course to also be able to position you to play all of these emerging themes in India. I hope the sessions that we had today helped you in some way, gave you some kind of food for thought and will help you in your investment journey. With that said, we have come to a close on Innowave 2024. Thank you to all of our guests for joining us, for taking us through all of their views, and to of course our audience for tuning in today.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.